All right, well, we're getting right past the top of the hour, and I think almost everyone that registered has filtered in. We might get a few more coming in, but we're going to go ahead and jump into this. I'm super excited to lead today's webinar with Nick Hogan, who is from Cincinnati Insurance, on the topic of bonding and everything. So I'll kick it over to Nick to go ahead and introduce himself. Nick, you're muted.
Sorry about that. I'm Nick Hogan. I work here at Cincinnati Insurance in the Surety department as an underwriter. I've been at the company about 4.5 years now, in the same department, commercial and small contract surety. I handle the Ohio territory. Excited to talk about bonds today with you guys.
Yep, and my name is Ben Todd, as you know, and I am at Granite Insurance, and I'm in charge of the trail building program that we run here. So I'm going to go ahead and share my screen. So you should be seeing the PowerPoint pulling up now. Nick, you seeing it?
Yep.
All righty. Before we jump into everything, just got a couple of disclaimers and housekeeping items. So the chat and the Q&A functions, those are both going to be available to you throughout the whole call. We'll check those periodically. And so if you have anything, feel free to throw those in there. You don't have to hold it till the end, but we should have plenty of time at the end for some good Q&A. This meeting is being recorded, so if you miss anything, want to go back and rewatch something, you'll get a copy of this once it is uploaded. And then it will also be on our website, so feel free to share this with anyone that you think could benefit from this. And then last but not least, this is all for educational purposes, so none of this is going to constitute financial or legal advice. And Nick's perspective, since he works at Cincinnati, will be that as of someone that works at Cincinnati. So there are other surety companies out there, and he will be the first to tell you that Cincinnati is not the only company out there to do surety. And so his perspectives will simply reflect that. So let's go ahead and kind of kick this off with an overview of today. So we're going to talk about the three-party agreement and everybody who is involved in the bonding process. We're going to talk about who all actually needs bonding and why. So obviously there's going to be a lot of different industries out there that require bonds, whether it be based on state laws, the type of bond that is needed, or whatever type of business you are running. And just as a rule of thumb, every state is going to have its own requirements for their bonds. So something we say today may vary slightly for the state that you're in. So just be sure to be aware of that. We'll chat a little bit about the submission requirements and what makes a good submission. What is Nick going to be looking for when he's working on an application? And then we'll talk about some tips to streamline this process. As I'm sure some or all of you are aware, this process sometimes can be tedious and can take a couple of days, but some of what we're going to talk about today should hopefully help to speed up that process. And then we'll wrap up with what actually happens when a claim is filed on a bond and what impact can that have on your company? What can that have on you as the owners? So we're going to talk about first the key roles. The obvious first one is the principal. This is going to be you guys, trail builders. This is going to be the person or company that needs to fulfill an obligation to another party. So typically that other party is going to be the obligee, in which case a municipality. So you're working for a local city, they require the bond. You are going to be the principal and they're going to be the obligee. They're going to be the party that benefits from the bond that you're producing for them in case you don't deliver on the build that you set out to do. Their financial interest is protected with this. And then the last party involved is going to be the surety. So in this case, Cincinnati is going to be our example surety for the day. And they are the insurance company that issues the bond, and they're going to be the ones that bear the responsibility if for some reason, if I'm the trail builder today, if I can't complete my project, Cincinnati is going to bear the responsibility for actually paying out any claims that are made against me because I didn't finish the project. and I didn't perform as we had agreed to. One interesting thing to note about surety is that while it's commonly thought of as a financial product, it's actually an insurance product. So you'll hear a lot of the same phrases that you hear when talking about your commercial insurance, like the underwriter. So for example, Nick is an underwriter at Cincinnati, but this is an insurance product at the end of the day, even though it acts very similar to how a financial product would work, like if you were getting a loan from a bank or something like that. And so I'm going to go ahead and kick the next slide over to Nick.
Yeah, so this slide, we're going to go over the main types of bonds that you guys might run into, or the situations you run into where you would need a bond. First one, just start at the very top. You see bid bond there. You guys may have had to get one of these before. So this comes up in the bidding process where you're going to bid on a bonded job. The purpose of the bid bond is just simply to guarantee that whichever contractor is awarded the job actually enters into the contract and then furnishes the performance and payment bond. So there's usually a percentage tied to the bid bond itself, and that would be the max liability of the surety. So if you have a 5% bid bond and you bid at $100,000, if you don't enter into the contract as the winning bidder, our max liability to potentially pay out on that bond would be 5% of your bid amount. Moving on to the next one, you got your performance bond, kind of exactly like it sounds. This situation comes up when you've already been awarded the contract and you're required to obtain a performance bond. This would guarantee that you complete the work within the contract per the terms and conditions listed within the contract. So, the only time that you would get a claim on something like this is, of course, if you were to default on the performance of the job. Next one, which is kind of tied with the performance bond, more often than not, you would be required to get both of these with your awarded contract. So the payment bond, kind of like it sounds as well, that guarantees payment of all parties within the contract. So let's say that you hire a subcontractor to perform a specific portion of the work. The payment bond will guarantee that that subcontractor gets paid for whatever work that they actually do. So if they don't get paid, of course, that's when you could run into a payment bond claim. And then, of course, if a GC is paying a sub who is then obligated to another sub for their work, that could be a situation as well. Last one on the list, we have license and permit bonds. These are not always required along with a bonded contract. These are more compliance types of obligations. So just because you're required to furnish a performance and payment bond, that doesn't necessarily mean that you need a license and permit bond along with that. So a good example that I like to use is a contractor's license. Let's say that you're based out of Charlotte, North Carolina, and you are going to do a job in Cincinnati, Ohio. The city of Cincinnati would require you to get a license bond, and that bond just guarantees that you act within compliance while you're working there with the city statutes, the code, everything like that. So it's not a performance or a financial guarantee type of obligation. Like I said, it's more of a compliance obligation. And then this slide kind of goes over two topics for bonding challenges specific to your industry and what challenges that you might run into when trying to get bonds. So you'll see the first bullet here. We have, why is bonding for recreational industries harder than standard construction bond? So a few things come to mind here. The first one being kind of what happens in a claim situation from the surety's perspective. So I'm going to touch on claims and the different ways that the surety can kind of handle them and proceed with the situation. But just to kind of foreshadow, one of those is to find a replacement contractor to complete the job. So the first thing that came to mind when I read this was that what you guys do, the trail work or really recreational work in general, is more of a specialized type of contractor. So if you were to run into a claim situation where an electrician defaulted on, a public apartment job, it would be very easy for a surety. We're familiar with a lot of different electricians to go out and find a replacement contractor to complete that work. That said, if we're building a trail or doing something similar, and a contractor were to fail on that type of job, it would be more difficult for us to go out and find a replacement contractor of that type who we are familiar with and who is familiar with this type of work to complete the job. So when it comes to an underwriting perspective, you have to keep that in mind. Of course, you don't want to write bonds that could potentially run into claims, but just keeping in mind that it is a more specialized type of work than a majority of the bonds that we do write. Moving on to the next one, other than company financial standing, what would rule out a project when another would be cleared? So specifically for this type of work, one thing that we would definitely take a look at would be the types of contracts that you're doing, as well as the job experience. So for example, on the types of contracts, we're looking for the terms and conditions that may be a little more risky. Oftentimes with these types of jobs, they can last a decent amount of time compared to, again, example, an electrician. So the amount of time that we can be on the bond can affect our underwriting just because we have to forecast out kind of the info that we're seeing in the current day. So, for example, if we're looking at a financial statement and we see a 6-month job versus a 1-month job, we see that as a little bit more risky just because we have to be okay with the current day information 6 months out. And then in terms of job experience, that's something that we're going to look at other than just the financial statement, in terms of the type of work as well as just the job size in general. So, if you're a trail contractor and you want to do a glass or a glazing job, we would of course have some questions about that. Why would you want to get into that? Do you have experience with that type of work? Things of that nature. And then just the job size itself, like I mentioned, one thing that we look at is your past completed work. So let's say that you want to bid on a job that cost a total of $5 million, but your largest completed job to date is only 500,000. A 10 times jump in that would be a pretty big jump, something that we're probably not comfortable with. Versus if you've done a $500,000 job as your largest past completed one and you want to do $1 million job, that's something that we would be more comfortable with. So those are a few of the things that we look at outside of just financial statement when we're reviewing a submission and kind of just seeing, what could potentially rule a contractor out from getting one.
Great. So who needs bonding and why? The obvious answer to who needs it is going to be all of you guys who are completing projects for some of the people that are listed on screen right now. So who is going to be requiring these? The municipalities that you're doing work for, the state entities, government entities like the Forest Service. And then we'll touch on why are they going to require these. So the municipalities, why are these important? Why do they care? Typically, these are going to be, like I said, some longer term projects that are going to benefit the community. The overall benefits and the overall why will better explain this, but to touch on the specific public benefits, the city of Hickory, 20 minutes from here, they just put in some brand new greenways and some brand new trails through town and over by the lake. That is a project that people had been talking about for a very long time. And so that project had been planned, and if suddenly all of the builders on that project, the people that were constructing these trails, just they couldn't get the job done, they defaulted for one reason or another, that would have been bad for the city on a couple of fronts. It might have been bad for the people that had pitched the idea in the first place, just for that idea to come crumbling down. It also would be bad for the city, who's trying to attract new people to move to the area by putting in nice brand new trails for people to take their families on the weekends or to go running after work or something like that. So if that suddenly wasn't delivered on, that would be a very big deal. Why the state entities, they're going to require it because of, again, and they kind of tie in with the government entities. They're just going to require it because they are legally required to. Obviously, contractors, trail construction, stuff like that is going to require it. We kind of touched on some of the other industries that require bonding as well. Obviously, there's financial, like mortgages and insurance, that are going to require bonding as well. But at least for where we're at right now in North Carolina, for me, the league, they are legally required to get a bond for projects that are over $25,000. So this number could vary state by state, but at least for where I'm at right now, if if you have a project that's going to be 100,000, you have to be bonded for that. So now to touch on a little bit of the why, and we've hinted at this along the way, but it's to guarantee that the project is completed according to the specs that y'all lay out during your planning phase. When you're going through all of your planning with the city to lay out all of the requirements for what they need, this is their guarantee. This is their way of being certain that they are going to get exactly what they want. Obviously, there's the compliance side of things to comply with all the laws and local regulations. Um, and then it's also again in benefit of whoever's requiring this, it's to create a safety net for them, um, so that they can guarantee that it's completed. And then last but not least, having this bond, it's going to show a level of responsibility and trustworthiness for your company. I think that's one of the key reasons that these are required, is truthfully because if you're able to get bonded for a large job, and that means a few things. It means you are financially stable. It means that you've been able to prove yourself in the past on prior work, and it means that you are going to be a stable company throughout the entire process, and you are going to be trustworthy, and you're not just throwing things out there and seeing what sticks. You're actually able to back up what you are signing up for.
So now that we've gone through the reasons, kind of gonna touch on specifically what we're looking for when we see a new account, what information might be needed from you guys when you need to get a bond. So I'll kind of reference this a few times, but here at Cincinnati, we kind of split contractors into three separate levels just based on the size of their bond needs. We have our credit-based program, our Surety Bridge program, which is kind of the in-between, and then we have large contract. So smaller bonds, this first bullet point, kind of thinking more of the small express or credit based program. The underwriting is pretty straightforward. We're always going to want an application along with a signed indemnity agreement. And I'll kind of touch on the indemnity agreement a little bit later, but that is a key point in surety. It's a difference between surety and insurance that if we do suffer a loss, allows us to go back and recover those losses. So in a credit-based program, along with the application and indemnity agreement, we're going to take a look at your personal credit reports, and that would be for both the owners of the company and their spouses. And then we would look at the business credit report, which we can kind of get more company level info, such as your payment trends. Do you have any legal filings like tax liens or business collections accounts, stuff like that. And then finally, kind of like I touched on earlier, we look at the job experience as well. Even though they're small bonds, our credit-based program goes up to 750,000. So when we're not asking for any financial info, we're putting a lot of value and weight on your job experience and credit. So we're typically okay with 2 times your largest completed job. So our application always asks for your largest completed jobs in the past few years, just to make sure that whatever job you're going to bid on or whatever contract you're awarded that you need a bond for, we feel comfortable with the cost to complete it and that you're familiar with that size of the job. Medium bonds, kind of as we get into larger submissions, we are of course going to ask for a little bit more info as we go. So in a medium situation, along with what we would need for a small bond, that's where we would probably start asking for financial statements. A lot of the times with the medium sized bonds, we can utilize a corporate tax return or even a QuickBook or other internal software system. We're usually looking for your past year or two for these medium bonds, really just the balance sheet and the profit and loss statement. And then at times we'll also ask for a personal financial statement from the majority owners. And then even getting up into larger bonds, what we would consider a large contract account, we put that threshold at around 3 million. That's where we really not only want to see, a high quality statement, but a high quality CPA reviewed statement. So as you get into these larger jobs, there's a lot more liability out there for the surety. There's a lot more trust. We kind of quote unquote get our hands dirty and figure out more info about your company. So along with the CPA reviewed statement, they're going to want the past 2 or 3 years of that. And then we oftentimes ask for supplementary info, such as a work in progress schedule. A lot of the times that'll be included in your CPA review if it's on percent completion basis of accounting. And then, if we're mid-year, we may ask for a year-to-date or a current day work in progress schedule, just so we can see what sort of jobs you have in your backlog, the cost to complete those jobs, just really getting more info on your financial standing that we trust from a CPA. Versus with the medium and smaller bonds, we're more okay with, an internally prepared statement or even just a credit report in the job experience.
All right, so now to talk about some tips to actually streamline the process now that Nick's kind of laid out what documentation is actually required at the different sizes. So the best rule of thumb is to keep on average about 10% of your working capital to your bond value. So how do you calculate your working capital? That's just going to be your current assets minus your current liabilities. So to what a good example of this would look like is if you had $200,000 in cash or other current assets that you could easily liquidate on hand, and you have $100,000 of short-term debts and liability stuff you got to pay off, you're left with $100,000 in working capital. If you multiply that by 10, that's $1 million. You should have no problem getting bonded for up to $1 million from a generally safe and risk-averse surety company. Now, there are going to be much more risk-tolerant companies out there, but they will charge you for it. So some companies may be able to get down around that 2% rate, maybe even a little bit below 2% if you have really good financials and really great credit. But some of these more risky ones, they might charge you 3 or even a little bit more in terms of a percentage when it comes to getting your bond. But maybe they're willing to go. So Nick was mentioning going 2 times over your prior job. Maybe those are the companies that are willing to go 3, 4, 5 times over your current job, but they're going to charge you, which means your bid is going to be higher because you've got to roll that cost into the project. If you're going to be operating other projects at the same time, I know a lot of the trail builders that we work with, you're constantly doing multiple jobs at the same time. Maybe you've got separate crews working on these different jobs. Let's say you've got the capacity for the $1 million worth of bonding, and you only have 5 other jobs that are $100,000 a piece out there. So you're using $500,000 worth of your capacity for bonding. If you go to try to apply for that $1 million bond, you're not going to be able to get it because you have a lot of work currently in progress. So there are kind of 2 scenarios for how you can increase your bonding capacity in that respect. You can either finish some of the jobs that you have already outstanding and get those wrapped up, and then that will help increase it. Or you can find a way to get more financial capital into the company. You can find a way to get some more working capital to increase your bonding ability. Obviously, they're going to look at your credit score. So if you're keeping strong credit, you're not over leveraging your company. That is going to be another really key factor to just being able to easily run the credit, see that it's a good, strong number, and carry on. Like it says, typically they're looking for 680 and above. I know we just talked about the CPA prepared financials being available for these multi-million-dollar jobs. If you have your year-end balance sheets and income statements already prepared for those jobs that are going to fall kind of below that threshold, if you can have those on hand, if you can have a year-to-date available so that you can show kind of live how your company is performing, if you have those on hand or you have the ability to easily pull those, that can definitely streamline the process and make it much more efficient for everybody involved so that you can get the bond turned around quickly. The works in progress, if you keep this live, if you keep it up to date, kind of saves you some time, because when it's requested, you don't have to go back and start updating the last 6 or 8 months worth of information on it. But at the same token, it will help you be able to see, what are we really doing? What all do we have out there, and what can we reasonably handle, and what can we take on going forward? So it'll help because it could be provided easily to the surety, but it also will help you guys. And then, at the risk of sounding redundant, I'll talk about having a copy of your assets on hand. So kind of falling back onto the working capital, if you have all of your current assets and you can easily provide those, that will go a distance in explaining your income statement and balance sheet potentially in a little more detail of what do you really have at hand. If there's something that for some reason is not scheduled there, if you have another asset you can share, that could also be very helpful.
Keep forgetting to unmute myself. But last time we kind of have the final step in what hopefully avoid in the claims process, what can trigger a claim, and then how the surety can respond to it. So the main thing or big thing to remember here with bond claims is the indemnity agreement that I mentioned on one of those previous slides. So whenever we set up a new account, and think of this as more like a standard market surety requirement, we're always going to want to get an indemnity agreement, which is signed corporately by the owners of the company. And then we'll almost always, 99% of the time, want personal indemnity from the owners and their spouses as well. So what this does is, if we do suffer a claim, the indemnity agreement allows us to go back to the company that we wrote the bond for, and we can recover those funds basically. And if their owners are signing personally and the company goes out of business, we can seek recoveries from that too. So throughout the claims process, those conversations are kind of ongoing if we do run into a claim. But the first step is, when a claim is filed, our team or our department in claims will start investigating. This is kind of the process where we gather all the info, determine all the facts, kind of just get a summary of the situation and determine, hey, is this a valid claim or not? If it is a valid claim, we have a few different ways we can proceed. And then based on that, that's kind of what dictates how much is paid out by us, as well as how much is paid back to us through our indemnity agreement. So the first way that we can proceed is through financing the current contractor on the job. I wouldn't say this is a very common way to proceed. Claims and surety aren't really common in general. But one of our options is to provide funding to the contractor who was in default so that they can complete the job. In a situation like that, we will then go back to the contractor after we complete the work, hopefully minimizing the actual losses that are taken. And after they've successfully completed the job, the money that we have lent them, we can then try to get back. The second option that we have is to find a replacement contractor to complete the job. Usually when this happens, it's a contractor that we as a surety are familiar with. We might write their bonds already. We present it to them, say, hey, this is the current situation. This job has X amount of work left to complete. And then if they're open to doing it, they would then enter into that contract with the obligee or the job owner to complete the work. And then finally, the last option that we have is we could simply just pay the obligee the claim amount. And this is typically the route that we'll take if we determine through the investigation process that either financing the job ourselves or finding a replacement contractor would be more expensive than simply paying the obligee the claim amount. So the thing that's important to remember with these claims is, there are certain nasty bond forms out there, and there's always going to be a bad contract that obligates us to some adverse situation where we pay the full bond amount. But most of the time with surety claims, our liability to the obligee, which is also as a contractor, your liability to us and the obligee, is the actual damages incurred. So the bond amount, let's say it's $1 million, that is our max liability. But if you default on a job and the job owner's actual losses are only 100,000, that is what we would actually end up paying. So in a situation where we just decide to pay the obligee the claim amount, we're just responsible for the damages. And then the obligee typically puts the job back out for bidding, just so they can get a competitive price for whatever work is left to be completed. So again, usually we don't run into a lot of claims in surety. It's kind of a common saying that surety is unique because it's underwritten to a zero loss ratio. So if we do our jobs correctly, we usually don't run into these situations, but it's always good to know, kind of how the process works, how it differs from your standard PNC insurance, and then just the options for what you can do if you do run into that situation. And I believe that is
Great. Yeah. So now that we've kind of just fire hosed you guys with some information for the last half hour, feel free to throw some questions in the Q&A box if you've got any, and we'll hang around here for a couple minutes. If nobody has any questions, then we'll wrap this up in the next, couple of minutes, but hopefully there's at least one or two questions that we can answer for you guys. Just gotta stop the share as well. Okay, we got a question. What's the typical cost and turnaround time for a bid bond?
That's a good question, actually. So bid bonds are actually, for any standard market surety, bid bonds are actually free of charge. So really, I shouldn't say we don't have any liability out there, but the thing to keep in mind with a bid bond claim, the only way that we would get a claim is if we write the bid bond, you bid the job, and then you don't enter into the contract. So we always keep in mind, if our contractor is bidding a job, they obviously want to do the work and hopefully make a profit on it. So yeah, most companies don't charge for bid bonds. Some carriers, I believe, will charge like a flat fee per year for all of your bid bonds. So, if you do X amount of bid bonds per year, they might charge you every single year, just January 1st, $500 or something like that. We don't do that. I think it's pretty common for bid bonds to just be free.
Good question. I did see there was a second half to that question talking about turnaround time. So I know typically from experience that on those express and credit based programs, if you have all of that information on hand, Nick, I think it's pretty common that these can be turned around in 24 hours, 48 hours max, as long as everything's in order. If there's any questions, obviously that'll slow down the process, but obviously, the larger contracts will typically take longer, but on the smaller end, kind of in that 750 to a million range, I'd say 24 to 48 hours.
Yeah, if it's a brand new account, like if it's your first bond that you've done, and we need to get the application, indemnity agreement, run credit, all that stuff, I would say 24-hour turnaround time is a good benchmark. If you do a lot of bonds with us, we have all your info on file. We don't really need to update anything other than log the submission. I would say Nate would be your underwriter, an hour max, really.
Okay. And so we had another question come in that said, is there a rule of thumb to estimate the performance bond cost? So Nick, I'll let you kind of answer this as far as a standard average kind of rate that Cincinnati will look at. So
Yeah, so this is across the board with any surety, the credit-based programs. So really just running credit, looking at job experience, no financials. That is almost always a flat rate based on the bond amount or the contract price. So that is usually anywhere from 2% to 3%. And like I said, that's a flat rate. As you get into larger jobs, our Surety Bridge program or large contract, sureties will base your rate on a tiering slide. So as the contract gets bigger, that portion of the bond amount is offered a lower rate. So an example of that would be if you have a $1 million job, the tiers usually start to tier down after 500,000. So our starting rate for our bridge accounts is 2% for the first 500K in contract price, and then 1.6% after that. So 18,000 for a $1 million bond. And then that said, like I said, the larger you get in the contract price, the bond amount, it tiers down even more. So part of the rate, that's the 2/1.6%. That's kind of our starting rate. We can always go lower depending on the quality and the strength of your financial statements, as well as the type of work that you're doing. So in terms of strength and quality, do you have a CPA review? Do you only have an in-house statement? What's your working capital, your equity, your year-over-year profits? We're looking at that type of stuff. And then to speak on the type of work, something like lawn mowing, that might get a lower rate than something like, glass and glazing or bridge building, something like that. That's a little bit more risky. If you tell your insurance agent, or your agency kind of where you need to be at for the rate, or if you think you should be lower, no underwriter is going to say, no, we won't even consider it, just kind of keeping the conversation, the communication open.
Good questions. Any more? All right, well, if we don't have any more questions, then we can go ahead and wrap this up just a little bit early. And I want to say thank you again to Nick and to the PTBA and every member that's on here. We really appreciate your being attentive and joining this afternoon. I know for most of you, it's during the workday and kind of right in the middle of it. So we really appreciate you all hopping on. If you have any questions, feel free to reach out to us. Aaron has my contact information, and I will make sure if you have questions for Nick, I will make sure that all of those questions can get to him, and we will get you an answer just as soon as possible. So again, thank you all for hopping on, and have a great rest of your afternoon.
Sounds good. Thank you, guys.